Hello and welcome to Trading the Trend. My name is James Boyd. Alongside with me, my good friend Brent Moore's in the chat. We welcome him and all of you here today. Randy, Mike, Rusty, Kevin, Sia, Bill Barnhoff, and many others. Welcome to all. Quick reminder that this session is not a one-off session. If you go to the youtube.com, you search for Trader Talk Schwab Coaching Webcast. We have a channel. And what you're going to notice is on our channel, we have playlists. Each playlist is really just a separate class that we teach, and you're going to see that this link that I send to you is the link, the playlist link for this class. So that way you can actually say, well, what have you talked about the last couple of weeks? And you could also see those and have an opportunity if you want to, or have access to download those as well. Some of you have that service through YouTube. Just real quick as we get started, want to make sure we're going to talk about really today managing some positions, some stock and option examples. I think we're going to have some good examples to discuss. Now, also remember when we talk about examples, we'll talk about stock examples, we'll talk about options examples. Tomorrow, Kevin and I will talk about ETFs in the morning at 9:30 a.m. Eastern. That session is not recorded, so it's live only. Tomorrow at 9:30 a.m. Eastern, topic on ETFs. Now, remember when we talk about options carry a high level of risk and are not suitable for all investors. The information provided here is for general informational purposes only. Also understand that this webcast discusses technical analysis. There's other approaches, including fundamental analysis, that may assert some different views. It's a good idea to see those different views because we know that other people have different views than what we have, right? And that way, if we can kind of see what other views there are out there, we can kind of formulate some ideas of what investors might be thinking, not just as a single approach, but maybe looking at from a different angle. Now, also remember the example trades that we'll do will be on the Paper Money software application, and also remember that investing involves risk, including loss of principal. Now, I want to talk about just real quick the indexes, briefly the sectors, and then I want to kind of have like a big boy, big girl discussion on a couple positions that are in the portfolio. And then I want to kind of talk about some of the new positions that we might consider adding to the portfolio. Now, just real quick, if I were to ask you a question such as anything standing out to you today in terms of indexes, anything standing out to you in terms of sectors, okay, let's start there. Any index that's standing out, any sector that's standing out. Well, if we went to just real quick the SPX, for example given, I mean, I don't want to be, you might have seen that show where the guy stood there and said, today is a new high. Okay. Now, I think this is the 12th new high, right? And what you're now going to notice is if you get a trend, higher highs is a part of the trend. And what you're now going to notice is we talked about kind of those double bottoms, the cross, and it's just kind of still going, okay? Now, today was higher at the intraday point earlier this morning, nevertheless still higher than where we were yesterday. So the SPX, something in terms of sector-wise, has to be going up because it's driving the SP as a whole up. We'll talk about the sectors in just a moment. NASDAQ was the one that kind of got pushed down a little bit with the semiconductors. You're actually seeing the NASDAQ fighting back here, okay? After leaving 2 days in a row of intraday lows on the WIX and then pushing back up a little bit here. So the NASDAQ kind of showing a little fight. Now, remember, the whole moving average is going to be closer to the current price. So if you went down to, let's say, a 10-day exponential moving average, chart number 5, again, that line right there, and let me close this. This line, let me get the fibs off so we can see that, clear that drawing set. There it goes. And that line right there, the 10-day exponential moving average is going to give a little bit more slack. It's the same idea as the 10-day whole moving average. You're trying to see momentum. The moral of the story is the price is still above the 10-day exponential moving average, okay? This exponential moving average, more forgiving. It's not going to be as close as the 10-day whole moving average. But if we kind of said, well, in the last, let's say, 2-3 days, did the NASDAQ pierce the 10-day exponential? The answer is we can't say that. It actually went down to the 10-day moving average, and someone looks like they were watching that level. And they actually came in and said, let me buy some, the investor says. Let me buy some, the investor says. And it pushes right off that level. Now, that's not the first time we saw that. We saw that here. We saw that there. It did go lower. But you're going to notice that sometimes it gets almost within pennies of that line. Someone's watching. Shh, don't tell anyone. Okay, now, if we take a look at the just real quick, let's go back to chart one, the Dow Jones just briefly. Dow's actually had a decent little crossover, okay? And if you take a look at that, that was a decent push there, holding the 10 whole moving average right now. The Russell we're going to keep an eye on, that one, the one that kind of broke above yesterday. Could this be the red candle day? Again, not scared of red candles. If the red candle is still above the short-term moving average, this could be the pause before the push back up. Keep an eye on that. Now, also, when we talk about sectors, now we had a little fun with Dean yesterday. I had to have fun with Dean yesterday because my father's named Dean, okay? But if Dean talked about the communication sector yesterday, he said, I wonder if JB is going to talk about it, okay? Now, if you look at the communication sector, you're going to notice that that did go to an intraday high here today. Feel really bad for people that don't do top-down analysis. I mean, I just feel bad for them. If you do bottom up, it's kind of look like you're looking through a phone book, okay? Now, if we take a look at this and I went to Market Watch, quotes, and if I went back into, let's say, Visualize for just a second, we're going to go just take a look at the Visualize, okay? So Market Watch, Visualize, and then S&P 500, okay? Now, when we look at the S&P 500, you're going to really see there's the communication services. So it's not a huge chunk of stocks. It's really Meta and Google. Now, by the way, if you actually pulled up the communication services, are there any more stocks that are in that sector? Of course there are. But if we're talking about the S&P 500, it's really Meta and Google. Now, we talked about Google earlier in the week. It got a little bit of a push. And if you're looking, let's say, for Meta, it's also trying to get a bounce as well. But there's other stocks in there that are also trying to get a little push. Speaking of, now this is where it's helpful to have your list, which was a homework assignment before, so I know you have it. So I can kind of be put on the, just pulling up the, if we said, hey, what other stocks are in that list? Well, you got TTWO, Take Two, you got Disney, you have Netflix, and you have Charter Communications. You have Verizon in that list and AT&T. You will notice T-Mobile here today had a pretty big push as well, so keep that in mind. And actually, when you look at this list, it goes over a little bit farther. It's going to be about right, and actually, I made this a little smaller, but I kind of based it on the market cap. If we talk about the sector, excuse me, you're going to see that it's like that. So obviously, the bigger, if we're talking about market cap, Google and Meta. But this whole sector, let me put a circle around it now, those are the stocks included in the communication sector. So Netflix, Disney, which has also been getting a push. There's your T and Verizon, there's the Charter, and then there's the T-Mobile, okay? So why do we tend to like to look at the bigger market caps first? The answer, liquidity, okay? That does not mean that the smaller ones can't go up, but we tend to like to look at, let's say, the bigger blocks because that's where institutional investors tend to be, okay? So just kind of keep an eye on that. Now, the other ones I want to go back to for just a second, if you look at financials, tell me what you see here on financials. Now, yesterday, we had a healthy discussion on that, right? And we kind of talked about some stocks that might be leading the space. One of the stocks we actually talked about was BlackRock, BLK. Second stock we talked about was the SIBO, okay? If you kind of think about it, like if there's maybe markets that are going to a brand new high, there could be asset managers like BlackRock that are also benefiting from the market going higher, okay? We also talked about, for example, who is on the back end, who is actually running, okay, who is actually, think of these, and I want to go to this just real quick. Let's go to Analyze. Let's go to Fundamentals for just a moment. So what you're now going to notice is they operate the options exchange. And we know that actually trading in general, investing, think of that there's been a lot of it, okay, over the years, increasing volume. Think of these companies like they're a toll booth. They might only get a penny. They might only get a nickel. But if the volume increases, that's a lot of pennies and nickels over time. And if you actually look at, let's say, the SIBO got a little push, The BlackRock, which we talked about yesterday as well, got a little bit of a push, always want a little bit more. ICE, we would also include in that list. We mentioned that yesterday, getting a little bit of a push. ICE, similar, if we go back to analyze, got ICE there. What do they do? What's the difference? They're the technology of it, right? And they're all over the place, right? European Union, India, Israel, Canada, Singapore, etc. And they're doing fixed income and data services. You need the data, okay, to get the pricing, okay, right? Now, and also includes the mortgage technology, array of derivatives contracts and financial securities. So think of these like the toll booth. Now, the one that was so obvious, did you notice I missed one? I missed to mention one that was so obvious. It was like I had like a stock right between the eyes and didn't even bring it up. I mean, this would even be more obvious than the three that I brought up. Could anyone actually guess which one I missed? Just take a guess, okay? Now, we're going to have a little fun with you, okay? So it's actually 4 letters. And this is if I said to you, hey, which companies are benefiting? Now, it's not Palantir, okay? Which companies are maybe benefiting from this push? BX, I wouldn't say BX yet, okay? I'll give you a hint. It starts with an N, and it actually has a Q at the end, okay? Now, if you pull this up, okay, now when I show you this, you're going to be like, wow, okay, I should have recognized that. If I pull this up, what we're now going to see is it's the NASDAQ, and if I pull this up, the ticker is going to be, let me actually pull up just real quick that ticker. And I want to make sure I get that right. Yeah, ND, excuse me. It's the N and Q are correct. NDAQ. Okay. Now this one, Captain Obvious. Okay. We're going to go to the analyze. And if we go to the analyze, what you're now going to notice is, guess what? Think of it like a toll booth. Operates the technology company, serves capital markets and other industries worldwide. This is even more obvious than the first 3. Now, they actually do capital access platforms, financial technology, market services, real-time market data. Geez, that sounds like what we're talking about right now. Now, if you take a look at this, if we pull this up, we can see some of that data down below. What is the price done? Well, sometimes you're just on it, okay? Now, so remember what we said yesterday. If the market goes to the upside, and that causes, so we're talking about pricing going up, if that volume actually comes in, these companies might benefit potentially from that push. Now, then there's banks, capital asset managers, Goldman Sachs, etc. Let's start here, that might benefit from that rise. And I want to kind of start here for just a moment. Now, when you look at, let's say, banks in general, right? Goldman Sachs, JP Morgan, Citi, whole 9 yards, right? They also, they're trying to they make loans, right? They make interest rate differential, right? But they also have trading floors or trading desk. So they're actually taking the bank's assets and they're investing those assets in the marketplace. So the money is not just sitting there, okay? They're saying, look, we're going to take some of the money and invest for the firm. Okay, now the example given, we're going to use Goldman Sachs. Okay, now if I look at Goldman Sachs, if I said, where do we see a potential support? Well, we've had a nice run to the upside, right? There might be some envy of saying, geez, I wish I would have rode that trend to the upside. We also now see kind of a recent area of support, little pullback right down to the 694. Now, a lot of investors, they believe the last bounce we had, but every new bounce, they just don't believe it. Now, remember, we have to get through my thick skull. My thick skull is that every entry has risk. So if we would have gotten in here, this had risk. Got in here, this had risk. Got in here, this has risk. So if we get in here, guess what? It has risk. How much risk do you want to take? So if we take a look at this, what I'm going to kind of focus on is Going back to the kind of the basics of what we're talking about. When did the 10-period moving average go green? On the 22nd of July. When did the 20-period moving average or both, when did the 20-day whole moving average go green or both the moving average cross over? Answer, that was yesterday. Today is a little pop in the price. Now, this is a bigger dollar stock. Now don't worry, we're going to do a couple. But if we take a look at this, I'm going to pull up, let's say, this is probably more of like a classic example of, and we're going to look at Love in just a second. But if I look at, let's say, Goldman Sachs, what you're now going to see is, and I want to make a point here, okay? Usually higher price dollar stocks with people that have experience with options and want to trade those, they might say, James, this is kind of more like a classic vertical type trade. It doesn't have to be. You might say, look, I got a bigger account. I'm going to buy some shares, whatever. Some investors, though, might just say, I'm going to vertical it. Now, I want to go to the trade tab for just a second. I want to look at GS. And what I'm going to do is I'm going to be in the margin account. Now, we have a situation where that account is actually negative cash. And so I'll show that in just a moment. We need to adhere. We need to administer to that. What we're going to do before we go there is we're going to come over here to the put side. Now, we always remember that if someone does a short put vertical versus a long call vertical, you're really doing the trade more for probability. You're trying to really have like a lower break even. Now, if we actually pull up, let's say the 705, we're going to use something in between a delta of 30 to 40. If we right click on that 705, the bid price, the 705, the put, okay, and we're going to look at the next 22 days. We're going to sell, we're going to go to vertical, and if we did that, it's going to be the 705, and we're going to widen this out a little bit. It just really comes down to what you could risk and also how many contracts you would do. If we did the 705 and the 700, why would we do that? We might not be able to take a $10 wide spread, okay? And if we did two of the 705 and the 700, why wouldn't you just consider the 705 and the 695 if they were both liquid, okay? Now, if we take a look at the credit, 252, we look at the max loss given the vertical, it's really 750. So it's like a 1-to-3 reward risk ratio. Pretty normal, okay? And you're going to notice that when you look at that 1-to-3, it has a break even at expiration of 702.48. Now, we can't think of this as, oh, it can't ever go down to that price. The answer is sure it could, okay? So this is break even as of 22 days from now, which we can see right there, okay? Now, what I want to do is I'm going to go ahead and send this, okay? I'm going to go ahead and send that order right there. And I got an interesting, I haven't seen that before, where it's saying there's a expected to place the account in a concentrated position. So that's going to be interesting. And if I take a look at that, now I'm going to the next thing I'm going to do is I'm going to focus on this negative cash, okay? And I'm going to show you what happened just real quick. I'm going to go back to the monitor, and why is it saying maybe something like what we just saw? Well, one of the positions that I thought I put in the IRA, or I think we had an issue with getting filled because that account is pretty well fully invested too, is Expedia. Expedia has, and we need to hit this right now, 100 shares of stock, and the stock, for example, is at 190. You see the kind of the problem? Well, that's $19,000, right? So $19,000 of an account that's $34,000 is in this one position. We have 60% of the portfolio in one ticker. Now, thank heavens, it's a caller position, okay? Now, what you're now going to notice is just briefly before we have to sell that or trim the position, we're going to show the example of selling it. Just in taking a look at the quick numbers, just briefly, okay, to get a little quick practice. Let's just say 186 is what the stock was purchased for. Sold the call at 200. The difference there is going to be 14 bucks. This, what you're going to notice is the call and put are almost equal. So it's just going to be like, I'm going to kind of look at this and say, look, the maximum gain is probably somewhere close to 14. How much do we have right now? Answer, 223 of $14-ish. So we're like a seventh of the way there, but I want to see what's going to happen. Problem is, can't really see what's going to happen because we're in a negative cash position, cash balance. When we started this portfolio, like right before Christmas, we said, look, we're going to start with actually the amount that we did. I can't state with what we started at. Hopefully you have a good memory. The other thing is also with that is it doesn't assume you're going to do all the trades we actually going to do or the strategy you're going to do, just for demonstration paper money purposes only. Now, if you take a look at this, is we're going to actually exit this position. So how do you exit this position? We're going to hold the shift key down. We're going to hold the shift key down, okay? Well, then what we're going to do is we're going to right click and we're going to exit the caller first. The caller is the options, okay? And then after that gets filled, what we're going to do in this case is then we're going to sell the shares. Now, this might take just a little bit. Just because we put an order in doesn't mean it just comes immediately out the other side and like, hey, something's wrong. No, you gotta see if there's any matching liquidity. Now, if you look at Expedia, luckily there's actually been 500 contracts over there. And luckily, actually on volume, at least on my paper money, it says NA are not available. So if this doesn't fill in the first 2-3 minutes, I'm down here on the bottom left-hand side, it did sell. No, that Goldman Sachs fills, okay? So if this does not fill, in the next 2-3 minutes, we'll go in and adjust the price a little bit. Second, once that fills, if it does, then we're going to come back in here and actually sell the 100 shares, and that's going to relieve the pressure on the cash balance, okay? Now, all right, so what do we got here? Oh, there it is. Okay, so what do we do next? Right-click on the shares, create closing order, sell. Now what's going to happen is when we actually sell that, it's going to be $19,000. If we have $12,919 negative, we sell $19,000, we're probably going to have a cash balance right around $6,000, $7,000. Confirm send. There it is, send. And we look at that cash balance and kind of see where it is. We said 6,000, it says 6149. Okay? Now here's the thing. This is kind of like driving, right? If you realize you're going down the wrong road or, hey, this wasn't supposed to happen, a lot of wise people might say, look, I'm not going to drive further, okay? I'm just going to turn around. And so it's not about, well, I could have made more, wonder if I could have done this. If the investor realizes they made a mistake, some investors just stop. Even if it's a gain, slight gain or slight loss or a big loss, they just say, hey, look, that was, we're trying to adhere to the rule set. Once we realize there's a mistake, irregardless of how much more upside there could have been, doesn't matter. Okay. Now, first off, any questions with that? Okay. Any questions? Now, the one I want to kind of just look and see, just kind of give you a moment and see if there's any questions. Second, what I want to do is I want to look at a Dow stock for just a moment. Okay. Now, one of the Dow stocks, okay, so we can close this down now. Anything that I kind of expand like that, that's kind of one that I'd like to talk about. Now, I want to kind of go back to one of them, Amazon. Now, I'm just going to kind of say something. We had a discussion on this 2 weeks ago. So when they came out with the announcement regarding Social Security, and perhaps that some people might not have to pay taxes on Social Security, we talked about, man, that's a big deal, okay? What do people tend to do when they have extra money? Buy miscellaneous discretionary items. That's number one. Number two, they might go on vacation. Okay, we know people like vacation, don't we? The third thing they actually might do is they actually might, for example, go out to eat. We know people like to eat and need to eat. But the moral of the story is smell that? We're sensing like a discretionary theme. Okay, and that discretionary theme could be, let's say, a company like Amazon. It could be a shipping company, like cruise company. Now, by the way, it could also be Airbnb, Marriott, the whole nine yards, Royal Caribbean's, Carnival Cruise Line, Norwegian Cruise Line, and we could also say it could be like Texas Roadhouse, Darden's, the whole nine yards. There's a little theme here. Okay, now if that caused that some people might have an extra $500, $750, $1,000, $1,500 a month. Did you hear what I just said? A month. And you add that up for a year, that kind of adds up. So where do people tend to buy stuff? Now, it could be at Walmart too. Is Walmart actually going to the upside? Doesn't look like it right now. The question that gets asked is, well, where are people putting their money? If the stock's not hitting a brand new high, they're probably not putting their money there yet. Now, you could say, well, maybe they bought it off the bottom of the range. Don't forget my point. Is it hitting a new high? Well, if they're really buying it, they're not buying it to such an extent where it's hitting a brand new high. Are they actually buying stuff at Costco? Well, we know they're buying stuff at Costco, but are they buying the stock? Simple answer is, if we get a red shading on the moving averages, are they buying the stock? Well, if some people are buying the stock, it's like an avalanche to the downside. The buyers cannot overwhelm the sellers. The sellers are overwhelming the buyers. So, and by the way, if we brought up Target and said maybe they're going to Target, well, I mean, look, this is very, very recent that maybe that stock is trying to come off the bottom, but we cannot give a trophy to Target at all in terms of trend. It has been, silence can't be misquoted. I won't even say it. You say it. Okay? Now, so if we came to one of those and said, look, out of those four that we just mentioned, which one has maybe a stronger trend? Some might actually choose Amazon. Now, the biggest thing is we just kind of want to take a quick peek at this, and we just want to kind of say, look, is there any position that's in the portfolio on Amazon? So here's the thing. You can watch the charts all you want, but the question that might pierce the mind is, does the investor have, or do they want to have exposure to that type of trend? Now, what you're now going to notice is there's a put spread on that. Fine, okay, that's an example, and it's not something we need to focus on yet. If we actually take a look at the IRA, is there any position in the IRA there? No. So the only position that we really have on that is in the margin account. Oh, it's so sad. Okay, maybe. Now, what I want to kind of talk about just real quick, briefly, okay, is this. I want you to imagine that someone, let's say, traded, they got in here, and the stock is here, okay? Now, in this class, we talk about stock, we talk about a cover call example, we talk about a collar example, we talk about, for example, let's say a vertical, okay, a long call vertical, a short put vertical. We even bring up examples from time to time on, let's say, a long synthetic. If someone would have got in here and then got out here, it doesn't matter if someone had the stock, the cover call, the collar, the long call, and the short put vertical, that's a V, okay, or the long synthetic. If someone did any one of those strategies and the stock went up, a lot of people will say, well, what's the perfect strategy? Well, I'd back that up. The question should be is, which type of trend? Did you get the trend right? Okay, did you get the trend right? Second question is, or what were you forecasting? Did it do what you thought? Second question would be, what strategy did you have? Which with each one of these strategies, stock, cover call, collar, vertical, long synthetic, etc. The question is, how much would those strategies could have benefited? What was the break evens? And is there a built-in potential maximum? That's the difference. But if someone did a cover call, or they did a collar, or they bought the stock and they did the long synthetic, the answer was, well, how much did that investor make based on that strategy? But the biggest question that people miss a lot of times is, did you get the trend right? Because if you get the trend wrong, or the stock goes in the wrong direction, the strategy can influence what the max loss could be, etc. Is there built-in max loss? But I think there's an under focus on getting the trend right. I'm going to tell you right now, I think there's fewer people than you think that are really good at reading trends. Oh my gosh, like he went there. I tell you, over 25, 30 years, there's a few people, okay, that I think really have probably 25 years experience of really kind of saying where they might think the market go, and they're good at it, okay? I am not talking about people that have been in for a year or two, okay? You might know who some of those people are, or some of the people that you've listened to for years as well. So getting that trend right is key. Second point is, which strategy did you pick? Now, we have an earnings coming up. When we talk about stock, cover call, collar, vertical, long, synthetic, sometimes with the earnings coming up, the investor might choose a strategy that has a built-in maximum loss. Well, so here's the deal. If we came back to this and said, well, why do you care so much about the maximum loss? Well, example given, Love, that did not give love here today, gave everything but love, okay? And you're going to notice that sometimes on earnings, you can get gap downs. So this is why people study strategies like Mary puts, collars, verticals, where if that stock were going to have, let's say, a bad reaction, like IBM, like Tesla, and they can't control where the order fills using a stop, they say, can I adjust the strategy? Now, example given, we don't know what those earnings are going to be. We don't know. That's number one. Number two, we do not know the intention of other investors of what they are going to do. We don't. Okay. Now, what I'm going to kind of focus on here is we're going to try to go back to the short put vertical. I'm going to try to give a little bit more time. Okay. The one thing we got to be very careful in the paper money account is if all of our trades are in the same expiration and the market goes down, we get the trend wrong, and everything's in the same basket. Now, I want you to think of this like the fridge, okay? You open up your fridge and all of your food expires in 5 days. I mean, you better eat up, okay? But you might not like that because you're like, well, what happens if the eggs, the milk expire in 5 days? What's left in the fridge? Okay, or the freezer. Well, so what we're trying to kind of do is we're trying to kind of create some separation between everything in the portfolio being at risk to the duration of the next 22 days. You want to put your finances on the line for the next 22 days. I don't know what's going to happen in the next 22 days per se. Well, sometimes the trend just goes the wrong direction and you run out of time. That is the bad part of the options, okay? What we're going to do is with the 19th September, with 57 days, we're going to come down to the 220s. Now, why did you focus on the 220s? Answer. Well, if we know there's earnings coming up, the investor might choose a strike, and we could say a strike that has a lower delta. And what is delta? Delta's chances of the stock, well, the statistical odds, as of right now, the stock to close below that strike by a penny. Delta is also the approximate change in option value given a $1 move up or down in the stock price. I like to think about the delta as a conversion. If the stock price goes up $1 or down $1, what's the conversion to the option value? Stock goes up $1, the option price, delta conversion, the option price goes up by approximately what the delta is, or down. Okay, depends if the stock goes up or down, and if you get the direction right. Now, what I'm going to do is I'm going to right-click on the 220, sell, and we're going to go to the 220 to 210. Now, what you're now going to notice is if I look at the 220, 210, the credit there is 236. Remember, if you do a short put vertical, you are trying to trade the probabilities. You're trying to have some bullish exposure, but you're really trying to get time decay. You're trying to get some volatility contraction, but since you're on both sides, you're short and you're long, it's really more trade slightly about direction, yes, but it's really, you could almost say to a degree, right behind getting the direction right, time decay. Now, if we go confirm and send, second trade that we'll see here is we're going to do actually the Amazon, the 220, and the 210. Now, if we take a look at this, what you're now going to see is max profit, max loss. Now, some people might look at this and say, I never do a trade where the max profit and max loss are this inverse. Well, there's a lot of companies that actually do these type of trades, but they're based upon probabilities. Now, what we're going to do is notice the commission as well. And what we're going to do is send that order. Now, I want you to kind of keep in mind when people, for example, get Social Security and they might not be taxed, where are they putting the money? Okay. Now, if I look at Royal Caribbean, which again, people like to go on cruise, CCL, or just kind of just go on vacation, whatever. If we look at CCL, if we look at NCLH, okay, I'm also going to include Texas Roadhouse, okay? Now, I don't know where you are, but if you look at this, I just want to keep an eye on this. It's not breaking out yet, but the other one I want to kind of keep an eye on is Darden's, okay? And if I look at Darden's, DRI, that's the other one. So at least the restaurants, these two that I'm kind of thinking of just initially, they're not breaking out yet. So far, it's really been Amazon and more of the cruise ships. Keep an eye on those. But if we kind of zoom back, what we're really saying is we're really looking at the sector of consumer. Let me pull it up on this chart. It's really looking at the sector of consumer discretionary. Okay, that's really what we're talking about here. Okay, could that actually go up? Now, any questions that you have? Now, the one that I want to kind of take a look at. Now, the reason why I kind of bring up Texas Roadhouse, I don't know about in your area, but that's almost like I'm just blown away, like at the number of people there. It's always busy. I swear. It's now the other one that's actually has decent value is Darden's. Okay, that also has a decent trend as of lately. If you talk about the last year or so. So just kind of keep those in mind. They're not recommendations. We're going to keep an eye on those. Now, I want to kind of go back. We said yesterday and the day before, I'm going to kind of keep an eye on Apple. Pia brought this up. Now, yesterday we did a buy stop order, and we're just kind of wondering, did that go above the high of the low day? Now, remember, the high of the low day is just looking at the most recent the most recent red candles. Well, there's only one of them. So this makes it really simple. All right. Did we trade above the high of the low day? It doesn't matter if it was intraday. Okay. Well, it actually did. So the question we got to ask ourselves is, in the paper money count on either the margin or the IRA, is there any trade in there if we look at the margin and we look at the IRA? Now, the comment was, I believe, yesterday that, hey, I think you didn't, we need to kind of put that back. But if we go back and look at that, and I don't think we took it all the way through, but we're going to go back and push it through, okay? Now, this today, had that been in the paper money and we sent it all the way through, that should have triggered. I think we used like 25 cents above the high. So what I'm going to do is I'm going to right click on the current price. We're going to go buy custom and we're going to go with OCO bracket for just a moment. Okay. So right click on the chart, buy custom with OCO bracket. Now what I'm going to do is when we started this account, we kind of said, look, any the margin account, max position, 10% of the portfolio, right? I mean, if you pushed it 15%, 10% would be $3,400 of stock. So if I come back in here and click on the pool balls percent dollar amount, I typed in $3,400 and said, how many shares would that give? It's going to give how many? Now, right when I do that and type it in, press enter, right above the dollar sign, it's going to have like a red icon. Click on that. And what it does is it snaps row 2 and row 3 and says, James, this is going to be about 15 shares. Right below that, click on the dollar amount again, and that little, I call them the pool balls. This is just the number, it's the value in units, it says, or shares, right? Well, I'm just going to now type in plus 15. When I type in plus 15, the sell is at 15 for the target, the sell is at 15 for the stop. Now, what I'm going to do is go limit day to GTC, stop day GTC. Now, you got earnings coming up, okay? Now, here's the deal. Sometimes, and I've done this too, oh, I got earnings coming up, I'm going to set a tight stop. Well, how would that have worked with Love or Tesla, right? Setting a tight stop does not necessarily mean that's where the fill is going to be. So what we're going to do is we're going to try to give this a little breathing room, And if we go back and say, where was the old support levels? Right about 208.84. Okay. If we take 208.84 less 2%, it's going to be right at 204.66. Now, wait, why are you doing this again? Well, because I don't see the order filled. Okay. 204.66. 204.66. Now, when we do that, when we go back and say, where might this try to go up to reapply? If we said, where might it try to go up to? I mean, if we're talking about like the first resistance area, it's probably right in the ballpark of, let's say, 223. It doesn't mean it can't go up higher than that, and it doesn't mean it's going to go up higher than that. But that's where the investor might set an initiable target. Okay? Now, seriously is our comedian here today. Seriously, I'm just having fun with you. He says the airlines are landing. Okay? And we thought someone has to be the comedian. Okay? Now, if we take a look at this, we got a target, got a stop, confirm, send. Now, notice it says with the stop orders, there's no guarantee the execution price will be equal to or near the activation price. Send the order. And that order is sitting right there. Now, this is a limit order. This limit order is saying, look, it's going to buy those shares or willing to buy those shares at 214.83 or higher. It filled at 214.80. Now we have the target price and the stop underneath. Okay? Yeah, someone has to be the comedian. Now, speaking of airlines, let's go back and let's take a quick peek. Delta, kind of fading a little bit here. Now, it's kind of been the 10-day whole moving average, and this goes back to the common denominator. Man, if you got the price below the 10-day moving average, man, it tends to be ugly, okay? You tend to get more red candles than green candles. If the green candles go up, if there are green candles in general, they tend to be, let's say, 3 days or less. And then the red candles come back in again. So we only went up for one green candle and then whack, 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 whack. Now this a lot of times when you finally get a green candle, when the price is below the 10-day moving average, you hope that it's at the bottom and it's going back up. So get your hopes up. And then it just whacks it down, or tends to, further. Now there's a lot of examples of this. I'm telling you, I think this right here, this is a pattern where, it could take 10, 15 years to fully let it sink in. If you said, I don't have 10, 15 years or, for whatever reason, moral of the story is if the price is above the 10-day moving average, pullbacks tend to be less than 3 days. They tend to be, not always. If the price is down below the 10-day moving average, prices tend to go up less than 3 days before the red candles could potentially reoccur. Write that down. It's very important. I'm telling you, you can fast forward your learning if you just stop fighting the trend that's present, okay? So if we go back and kind of take a look at, just real quick, another one, I want to kind of go back just real quick and look at, let's say, a couple of these stocks that are kind of standing out a little bit. So we talked about Amazon. We did the example on Apple. We also talked about the example of, let's say, GS. We talked about some of these stocks like BlackRock, right? BlackRock hit a new high. We did that trade yesterday. The SIBO, okay, it was push. The ICE, which is getting a little push, which I might come back to that. And the NDAQ, Captain Obvious, right between the eyes. Now, I want to go back to just for a second, the Intercontinental Exchange for a second, okay? Now, let's say, I want to kind of do an example. Let's go to the trade tab for just a sec. Let's kind of look and see what the volatility is. So when you look at the ICE, you're going to see that it's right around about the 21-ish area. Now, a lot of times when you take a look at this, and I want to kind of show this example. This morning, we had the VIX go down to 1495. Now, if you look at my X video yesterday, we kind of showed a picture of a boat rolling over and taking on water. Down to 1495. Oh my gosh. Okay. Now, what type of strategies when the VIX becomes lower kind of stands out a little bit? Well, if you get the VIX lower, maybe buying calls might be less expensive, lower break even, lower time decay burn. but also buying puts, okay, might be something an investor might kind of consider, given if the VIX is lower, the implied volatility of the stocks could be lower. And the investor might say, look, I like to buy stocks, but I'm going to buy a put, a strike, closer to the current stock price because they're less expensive. So when the VIX is low, some investors might say, James, what I'm going to do in 60 seconds, I'm going to come in here and on ICE, we're going to buy the shares of the stock, number one. Number two, what we're going to do is come first triggers SEQ, and we're going to come in here with the delta of 30 to 40, and what we're going to do instead of setting a stop, we're going to buy the put. So in wrapping up here, what I'm going to do is I'm going to say, look, if we buy shares and we buy a put at the same time, what do we call that? A married put, okay? So you're really buying upfront protection for a certain number of days, and this is a very important strategy when the VIX is low and maybe even getting lower. What I want you to do is I want you to practice 2 to 3 of these trades. Focus on examples of maybe stocks with an implied volatility level of 25 or less, maybe targeting in the high teens. Now, I'm out of my time here today, okay? But I want to thank you so much for your comments and your participation. Thank you, Brent Morris, for answering those questions in chat. Want to give us a quick reminder that the next webcast coming up, if you go right to our schedule, you're going to notice that if we go down, it's going to be short verticals with Connie Hill. If you have not subscribed to the Trader Talks channel, do so. Remember, with what we discussed here today was done for example, illustrative purposes only, and all investing has risk, and we want to be mindful of that. This has been the class on Trading the Trend. Stay tuned for Connie Hill coming up next. Take care. Bye-bye, and we'll see you tomorrow on the ETF class with Kevin Horner. Take care. Bye-bye.